Welcome to the Portfolio Builder Getting Started Guide. In this video, I will teach you everything you need to know to generate retirement income for the rest of your life. We will go over how to use our spreadsheet if you want to, or how to follow the program without using the spreadsheet. I will review our track record in great detail. Plus, I'll cover the difference from our basic program, our diamond program, and our whale club. They each have a lot of similarities, but are ideal for different portfolio sizes. And last but not least, I'll show you why we recommend a maximum 5% position in cryptocurrencies, which are actually up 72% so far this year, which means in our basic portfolio, we are about double subscribed. It's about time to take profits in this portion of our portfolio. So let's get started. The goal of this program is to stop speculating as to whether an individual stock will go up or down, and to take your savings and turn it into a business. A business that's a lot like owning a bank, but rather than loaning out dollars, we're going to loan out something much more interesting. We're going to loan out stocks and ETFs. And so in the basic program, the specialty of this product revolves around the SPY ETF. The SPY ETF represents the S&P 500, which means when you buy one share of the SPY ETF, you now have exposure to America's top 500 companies that are publicly traded. And this is the most popular ETF in the world. It has funds that are twice the size of the largest hedge fund in the world, which is Bridgewater with $120 billion. SPY has $240 billion of assets under management, and it's the most highly traded security in the world. $16 billion a day on average flows in and out of the SPY ETF. And what's more important is that the SPY ETF has the most active options market in the world. So now you basically don't just own a bank, you're going to own a casino. And if this looks confusing to you, don't worry. This is by far the safest and easiest strategy in the world for generating safe retirement income. We're going to do it by lending out our SPY shares to gamblers, folks who want to borrow your shares, and they will pay you anywhere from $50 to $150 to borrow your shares for a period of about 48 hours. So when I drop down this little arrow, you can see all the paydays in the future that await you if you only own 100 shares of the SPY ETF. Each of these dates are the dates when options expire, and that's when you can write a new contract to collect more and more income. And so just to do the math really quickly in your head, if we do an ultra conservative strategy that generates around $25 per contract 3 times a week, 52 weeks a year, that's $3,900 of income with a very conservative strategy and extremely high probabilities in your favor. That's over a 10% gain and, quite frankly, twice the average return of the S&P 500 over many stretches of time. But what happens if we actually generate a little extra? If we average $50 a contract, that is a $7,800 profit just from the covered call income, or a 26% annualized return. Now, I'm not going to even show you what kind of return you make if we pull $100 or $125 a contract, but there are times when we will generate that type of profit, and that's whenever the VIX, the volatility index of the S&P 500, when it spikes higher, our profits skyrocket. So this is actually a strategy that makes accelerating profits as the stock market goes down, which is very important because although the stock market may go up for another year or two, it's just as likely that it may go flat or down. And if you look at periods of time like the 60s to the 90s, there's plenty of opportunities for the market to disappoint and generate negative returns for decades. And so for Portfolio Builder members, that's just not an option. You must have a strategy that has downside protection at all times. And so that's what this formula for generating profits is all about. Now, to really oversimplify this, let's just tell you how it works. Step one, you're going to end up buying lots of 100 shares of the SPY. But do not purchase the SPY without our trade alert. Because the second you purchase the SPY, you also want to sell a call option to protect your assets and generate a profit. Now, most of the time the stock market goes up, and that's what makes this strategy so smart in the long run. But where we're really taking advantage of the situation is that these rises in the market tend to come in very sporadic times, and most of the time the market actually goes nowhere or slightly down. So let's just take a look at our typical trade alert. First of all, there will be a detailed video that's going to cover all of the news that I've been following over the past 24 hours. And the main thing I'm looking for are triggers in the stock market that could cause the value of the SPY to go down, which is perfectly fine for our strategy. We're going to compare the profit from one period to the next. So again, noon Eastern, Monday, Wednesday, Friday. Those are the main points in time that we will issue trade alerts. Every once in a while, we may get a double payday on a Tuesday, Thursday, and that's where we can take profits on our covered call early and write another one. That doesn't happen that often. Now, in this example, you can see we created a profit of $680 from Wednesday through Friday. On the trade alert issued on Wednesday, we generated a profit of $1,802. And on the trade from last Monday from the previous Friday, we generated a profit of $1,274. So obviously it's going up and down. Let's take a look at the actual trade alerts over this period so you can see how it works. Now again, there is the opportunity to lose money. This is not financial advice. All trading is risky and you can lose your entire investment. I have to say that. Let's take a look at these trades, how they did generate profit during this period of time, and what we're doing to protect your assets from downside risks. So step one, again, is to purchase 100 shares of the SPY. The more multiples of 100, the more contracts you can write. You're only allowed to write one contract per 100 shares you own. So the very first time you get into this program, you're going to skip step 2 and go straight to step 3. Where you're going to sell to open, and then you're going to follow the instructions. It'll be the next expiration at a certain strike, a call option, and we're selling to open. And in general, as volatility increases, we will make more money and be able to have extra protection. So let's take a look at this trade alert, which was a in-the-money covered call. And this is going to be your best friend during market corrections, market crashes, flash crashes, bear markets, recessions, you name it. This is the way you bulletproof your portfolio extremely easily, and you have no risk. If you're wrong and the market shoots up higher, we cannot lose. So let's take a look at this sample trade alert. You can see the SPY was trading at 283.99. Let's just call it 284 to make math simple. If I sell to open a call option, it means I'm agreeing to sell my shares at a certain price. And so the price I'm agreeing to sell my shares is $280. I can write one contract per 100 shares I own. So why on earth would I agree to sell my shares for less than they're worth? It's because the stock speculator in our little casino we've built wants to pay us $4.67, which is absolutely a great deal. This means the SPY can travel $4 lower and 67 cents, and we break even. If it travels $4 lower or anything in between, we make 67 cents per share. That's $67 a contract. Now, that may not seem like a lot of money, but let me show you how this adds up and how bankers and Wall Street in general get so rich. So if we can return $67 on a $30,000 investment, and the SPY costs less than that, so we're rounding to the downside here, that's a return on investment of 0.22. In banker talk, they would call that 22 basis points. It's not even a 1% gain. Now we take our $30,000, we grow it 156 times. This has years to grow, but just think about it. 3 times a week, 52 weeks a year, 156 opportunities to potentially return 22 basis points, future value $42,267. That is an annualized return of 40%. Now let's say you're not going to compound your profits because, let's face it, every time we collect $67, we can't afford to buy another $30,000 worth of stock. And if you're going to do this for retirement income, you may want to be keeping this. So if we just generated this 3 times a week, 52 weeks a year, that's $10,452 of income per 100 shares of SPY you own, just doing this trade over and over. Now I can tell you, if you follow my exact trade alerts, we're going to aim for closer to 15 to 20%, maybe overshoot a little bit. What you're going to learn is that this strategy is really good at avoiding loss. And so it's huge moves like this, where the SPY goes from 285 to 288.50, where this guy buying our call option gets rich and we have a fear of missing out feeling. We get our 67 cents. This guy just made around $3. And he's able to do it with a lot of leverage by borrowing our shares. But in the long run, the market really does a lot of going up and down and going nowhere. So if we can sell covered calls that are in the money as volatility is rising, it allows us to generate extra profits with extra protection in downturns and still be able to generate profits when the market rebounds up. So if we return back to this trade alert, what you can see is we have $4.67 of downside protection for the potential to generate $67 of profit, even if the SPY jumps to the moon. So this was the trade done on 5/15. As of recording this video, that's last Wednesday. Let's take a look at Friday's trade alert so you can see what your action would be. So the first step would be to buy to close our 280 strike. This is an example where the covered call lost money, but the SPY ETF went up in value. We cannot lose if the SPY goes up. We're really just worried about it going down, and we have protection. So you can see in this trade, we generated a $680 profit after closing that trade. And if I go back down to the instructions, step 1, buy to close the May 17, 280 call. Step 3, sell to open. So basically we're rotating from buy to close and then immediately selling to open. Buy to close, sell to open at the next date. Buy to close the same date, sell to open to the next. This is the process you can do for the rest of your life to generate income. Now the next big question you should be asking yourself is, well, how do we decide which strike price to pick? So I'll make this very simple for you. It has a lot to do with the VIX. If the volatility is increasing, that means stocks are on the way down. If volatility is increasing, the call options skyrocket in price, which means we make 2, 3, 4, 5 times the average income over the same 48-hour period. And we get to do it with a lot of protection by doing the in-the-money covered call. Now, as volatility collapses, the cost of buying call options drops. So we're going to have to slowly move it closer and closer to the money or above the trading price so that we can make at least $25 a contract 3 times a week. Now, the best indicator of where to put your money is where Wall Street's putting its money. This is called an option chain, and this is what I analyze each day for you. But once you've watched this video, you'll be able to do it yourself. So if you don't want to pay me to sit here and analyze all this data for you, no problem. What we're trying to do is basically be the leech of Wall Street. And so we're looking at where they place their bets and just going with the flow. We're following the whales. Open interest, volume, strike, calls, puts. On the left we have our calls, on the right we have our puts. The volume is that day we're paying attention to two things: the most open interest and the most volume of the day. Now, we're in the business of lending out shares. People writing put options are in the business of lending out dollars. That's a much more advanced strategy that requires you being very, very active. With our product, we have complete control of capital, and there's really no terrible outcome where we wake up and are sitting in a very nasty situation, which put option writers who don't know what they're doing will end up in that situation. So we are very interested in where Wall Street is writing put options and where they're writing call options. So we can see in this screenshot, they are primarily writing them at 288 on the call option side. So that means Wall Street will massively unload their SPY shares at these prices right here. 290, 288 are the big positions, which represent several $billion worth of SPY shares. On the other side, we have where they will buy SPY shares. So put options are agreement to purchase SPY shares at a certain price. And so we can see a huge amount of support at the 285 strike and also at the 284 strike. That tells me it's going to take a lot of capital between Friday and Monday, which the markets can't even trade, only the futures market Sunday night, to push it out of that range. So we went with a defensive play at the 285 strike. So let's take a look at the economics of this trade. Now, this is a trade that had a lot less volatility from Wednesday till today. And so as you can see, we're getting closer to the trading price. Now, this is still an in-the-money covered call, which are our favorite type of trades because we get downside protection for free. And if the market goes up, we still generate a profit. In this one, we're selling to open the May 20th 285 call option for a credit of $2.79. However, we're agreeing to a loss of $2.17. So it's easy to look at. The last trading price when putting this trade on was $287.17. If we look at the strike price, it was at $285. So I'm agreeing to sell my shares for a $2.17 loss while I get paid $2.79. So that's a $62 profit per contract with this defensive trade. Now, there will be times where we'll actually agree to sell our shares above the trading price, and that's when we can actually get what I call a double payday. Our underlying asset can increase in value, plus the call option loses its value because it doesn't get close to the price we agreed to sell our shares at. Now, from time to time, I will issue a hedge. The most deadly hedge we have, which I call the sniper hedge, will usually be a 1% position that we will put on when there is a fundamental risk to the markets. Right now, this is the escalation of the trade war with China and the US. So this represents just under 1% of our total portfolio. So basically, you just own one of these per 100 shares of the SPY if you were taking this trade alert now. Now, if you're watching this video, this may not still be an active trade. So you do need to follow the current trade alert. So this is a buy to open July 19, 2019, 264 put for $1.83. So what exactly does this mean? Well, this is a bet where Wall Street is actually taking this trade, and they would call this a speculative trade. And it's important that we're not doing this trade to get rich. We're doing this to protect our assets from a serious pullback. While the in-the-money covered call protects us Monday, Tuesday, Wednesday, Thursday, Friday, this will protect us overnight through the weekend and during times where we can't just be there to cover our covered call for a profit and move the strike lower. And so the basic math on this is if the SPY were to travel towards 264 and then go below it, we would generate very large returns. This covered call, or rather this put option, would be trading around $10 to $20 depending on how far below 264 it goes. It also has to do it well before the expiration date of July 19th. So if there is no pullback in a week or two, we would exit this hedge for a loss and then buy a new put option at a further date if the fundamental risk was still in the markets. Now let's take a look at the other option we have to help protect against downside, and that is the machine gun method. This is the inverse tech ETF and inverse bank ETF, which is TECS and FAZ. So sometimes we'll be looking for a sharp pullback that's unexpected, which is what that sniper out of the money put option does for us. Other times we might just expect a slow, gradual, where the put option may not generate a return, but if the market were to slowly drift lower, these would incrementally go up in value. So not only can we protect our assets with the covered call in the money on the SPY, we can also allocate capital to TECS and FAZ, and the nuclear option is our long put option, which in this case we actually have open. I rarely like to buy these because they lose money quickly. I rarely like to buy the inverse ETFs, and again, that's because the market's leveraged to go up. Unless there's a real panic in the market, it will go flat and then have sudden spikes up, which drives the business for speculators to buy call options from us. Now, if you're thinking to yourself, well, this all sounds gravy, but the commission costs are going to eat you alive, you're wrong. If you go to Interactive Brokers, it's cheap. If you call your current broker, tell them Interactive Brokers fees, they'll match it. And if you really want to be smart, this Robinhood app is the fastest growing broker-dealer in the world, valued at $5 billion. Rich private equity will pay for 100% of your fees and even loan you money one-to-one for free at Robinhood. This is a San Francisco-based company. It's growing much faster than any other stock brokerage in the world. It's valued at $5 billion, and it has the best platform to do this trading system on the go. Plus, all of these options and stocks are filled through the same liquidity pool, so you don't have to worry about getting a better price at one broker from another. And if you do follow the trades from Robinhood, they even have our cryptocurrency portfolio available. And it's nice because it's not real cryptos, it's a proxy, which means you don't have to worry about your Bitcoins being stolen or any of that nonsense. And you're federally insured up to $500,000 per account at Robinhood. All right, so let's jump through the track record, and then we'll go through how to use the spreadsheet for yourself. So the first thing you should notice is the color coding, which is controlled by these settings right here. So we can target how much of our capital is going into each section of our portfolio at different times. And we will rotate into different settings depending on what the market is doing. So to simplify things, when the market's expensive, we like to own the SPY because we have the most liquid option market with the most expirations. That means we can protect our capital while the valuations are expensive and generate a great return. And this is when stock speculators think the S&P 500 is just going to keep going up forever. And so at the time of writing this video, we actually have a 95% position in the SPY and currently have 8.5% of our portfolio in cash, which that 5% has been allocated to cryptocurrencies, and those are up. Now, I'm not reporting any of the profits from the cryptocurrency portfolio to here, and you can see that the crypto portfolio has actually generated more profits. But this is a risky asset, and it's really just an extra hedge which protects us against currency devaluation. So when countries start to devalue their currencies like they do in trade wars, we're seeing that Bitcoin and other cryptocurrencies are having spikes in value. But they can quickly crash. It's a very tiny market and should not represent a large portion of your portfolio. Now, there will be times when we want to go into a growth setting. This is after major market corrections. So if we are down 30 to 50% in the S&P 500, it's time to start switching towards a growth strategy. So we simply reallocate the capital to growth, and now we can sit back, write covered calls on the top ETFs of the world, and then ride on the QQQ, EEM, EWJ, VGK, and ASEA. Now, most capital is in the Americans. ETF QQQ, which is the NASDAQ 100, which can can typically go up in value 2 to 3 times faster than the SPY. So we only want to buy this when it's very cheap and after a hysteria in the stock market. This also puts a 25% position in the EEM ETF. So these are the top 3 highest traded ETFs in the world. First the SPY, then the QQQ, then EEM. Now, if you don't want to buy any of these certain ETFs during highly volatile times, it's easy to ignore certain ETFs and just follow the ones you do like. So some people have an ethical dilemma supporting China, which is what the EEM ETF does. Most of the time, 99% of the time, we're just trading the SPY, and then we're using either the TBT, the FAS, the TECS to hedge. So let's talk about each of these hedges and what exactly they do. So TEX is easy. It's the inverse of the technology companies. These are the premium companies that are growing the fastest that Wall Street loves the most. And so if there is a panic, this is the one that will most likely skyrocket in value dramatically. Now, a lot of the S&P 500 is held in banks. So if there is trouble, this is another good hedge with FAZ. These are triple leveraged to go the opposite direction of these 2 indexes. So they make for a very easy hedge that's just as simple as buying and selling a stock. Now, another risk we have is if the Federal Reserve raises interest rates, this is very negative for equities. And typically, they give us a lot of heads notice that they're going to do this so we can plan ahead. But when there is a surprise, this will be caught in the TBT. This is the inverse of the TLT ETF, which is long U.S. Treasuries. Now, currently, we're in a trade war, so we took profits on our TBT position and have been going in and out of this inverse tech and bank ETF alongside buying what I call the sniper hedge, the out-of-the-money put. These are very risky assets to buy because, again, the market is leveraged to go flat or up unless there is serious panics in the market. So you'll see, I would much rather have a risk-free way to bet the market goes down a little by writing an in-the-money covered call than by purchasing these risky assets, betting the market will go down, and if we're wrong, we can quickly lose. So now that you know the different features and strategies we're using in our basic program, let me quickly go over how to read the track record. And then after that, we'll get into the mechanics of how to start off from scratch and start filling out your own spreadsheet. Now, first of all, you don't need the spreadsheet. I do make this very simple. I'll be giving you instructions such as per 100 shares of the SPY, buy 100 shares of TEX, 200 shares of FAS, and 1 out-of-the-money put option in order to hedge your portfolio. Most of the time, we're just going to run with no hedge and protect our assets through the covered call. So only when there is spiking volatility and a fundamental reason the market could have trouble ahead will I put on hedges. If there's just little bumps in the road, that's why we make so much money doing this. If there wasn't volatility, the call option premium would be tiny. So we want some volatility. That's what drives the prices of these call options we're selling every Monday, Wednesday, Friday. So down here we have the buying and selling of the stocks and ETFs. Sometimes the profits are from the SPY increasing in value or our hedges increasing in value, and vice versa. We can also lose value as those go up and down. This is where we have our short option positions, and that just means we are writing a contract. In this case, we're writing an option contract to sell our SPY shares at a certain price for a certain premium. And so this is where we keep track of our open position, and then we close it and paste it down below. Now, I've organized this so the most recent trades are up top, but you can simply paste yours down at the bottom if you prefer. Now, it's important to realize when you look at the closed ROI, if there is a loss on the covered call, that means we generated a profit on the underlying asset. That means it was a double payday. If it was a casino, it was blackjack. The dealer got his tip, and the gambler made his money. it's when we have these 96 and 98% profits, they got to wonder what happened to the SPY during that period. So it is possible for us to sell a call option and then the SPY jumps down in value. That's when we get the near 100% profit on our covered call. So we actually don't want to get 100% profits on our covered call. We'd actually rather make a small profit on the covered call and get to keep the SPY as it travels higher. So if you were in the business of doing a rental business, perhaps with an apartment in New York, and you're using the Airbnb phone app to rent it out for short periods of time for top dollar. Well, that's what this strategy is a lot like. And so we don't really care if the value of an apartment in New York is going up or down, because we're going to hold on to this apartment for decades and we're going to generate income from it for decades. And so that's what we can do with the SPY ETF for the rest of your life. So if there's ever a confusing trade that you want to look at, just make sure to compare it to the trades that match up on the same dates in the stocks. What you're going to see is our portfolio rarely loses value, but just slowly gains in value. Now, the next thing I can think that you might be thinking is, well, this sure seems like a lot of work. Let's take a look at some of our more advanced programs. This is what we call our Diamond portfolio. It only trades Tuesday at noon Eastern, and right after we have a live webinar at 1 Eastern. To follow this program, you really need to have at least $75,000 in capital if you're willing to use one-to-one leverage, or $150,000 if you prefer to use no leverage at all. And that's because we're trying to replicate what the SPY ETF and QQQ ETF do for you in terms of when they get your cash, what do they actually purchase. And so you can see for your own eyes, Microsoft is the most important company in America by far, 4.1% position in the SPY ETF. If you look at that chart, it is incredible. They have a clear monopoly in the processing market and they are expanding into lots of growth sectors. But even bigger stories are Apple, Amazon, Facebook. However, in our portfolio, you will note that we did not include Amazon because it would cost over $180,000 to own 100 companies. And the same is true for Berkshire and Google. Now, if we go over to the QQQ ETF, similar situation. Microsoft's the top dog. Amazon, Apple, Facebook, Google, Cisco, Intel, Comcast. Now, we did pull away from some of the more brick and mortar companies like Johnson & Johnson. And we didn't include Berkshire because if we look at what Berkshire owns, they have a $183 billion portfolio, but nearly half of it is held just in Apple, Bank of America, and Wells Fargo. So if we look at the composition of our Diamond program, you can see that those are the companies we've chosen. It's because they have the highest demand of the ETF funds. And they have that because they're the most profitable companies in the world. So they have the best cash flow to buy their own stocks back. They have the best credit ratings to borrow money for all of their ventures. And they have the most buyers because of the ETFs dominating mutual funds and hedge funds. They're dying very rapidly because it's almost impossible to beat the return of the SPY. Now here's how you beat the SPY. Just copycat the SPY, buy the same stocks, concentrate it to the leaders, and write the covered call. This portfolio has delivered twice the return of our basic program doing the exact same thing. But now we can write a covered call on the individual companies and get twice the yield. Plus we can aim up and down with the covered call strike price per security. Once again, there's no magic to where we pick our strikes. We look at where Wall Street puts their money and we just copycat. Now I will point out that the ETF hedge for this is to short high yield debt. So that'll be the first credit market most likely to collapse before this high grade credit market collapse, which will help stop the corporate buyback mania. And that's why when the time is right, we can hedge our portfolio very easily in this portfolio through the short high yield SJB ETF. So this works the same way. Down below, we have our stock trades. Up here, we have our covered calls that are open, and down here, we have them being closed. This year, we've been writing mostly in the money covered calls. That means we make less when the market goes up, but we have downside protection. Most of the year, we've had this fear of missing out feeling everybody else is getting rich while we're making the same boring returns. But don't forget that 5% pullback thanks to a little Trump tweet. We didn't lose a penny. So when our product really shines is that we just don't lose money. That's it. We don't lose money. We protect capital. We go for a smaller, safer return over the long run. Now, the characteristics of the Diamond program is that you have between $150,000 but less than $1 million. You want instant results. You want to see profits this week. That's something I can deliver for you with great protection week after week immediately. We will weather all storms. We will hedge when the time is right. And we're pretty much going to constantly own these companies with covered call protection. I have a third portfolio that is only delivered on Thursdays called the Whale Club. This one is not an anxious strategy where we're immediately wanting to buy stocks no matter what the valuation is at. That means most of the time we're going to sit on the TLT, the US Treasury ETF, and let people speculate just how long this 30-year bull market in the US Treasuries will continue to run. And so there's a pretty good option market for that. It's not as sexy as the SPY ETF, and it's only weekly. But you can see it is keeping up with the same returns as the SPY program with less work and a lot less volatility. The TLT hardly budges because the Federal Reserve is very, very protective over the rates. And so 99% of the time we will either be long US Treasuries or short US Treasuries. And when there is a very good spike in the VIX, which means we get around a 20 to 30% plus correction, we will jump into this stellar lineup that does cost about $1 million to build. And the reason why it's going to cost so much is because we don't want to be overloaded on Amazon. So we're basically going to own around $100,000 to $200,000 of Microsoft, Apple, Amazon, and Google, and then substantially less of Facebook and similar amounts of capital in Bank of America and Wells Fargo. So this allows us to still have the same composition as the SPY or the QQQ without missing out on two of the most important companies. Two companies that may become more valuable than Apple and Microsoft in the long run. So this one is patient. It's happy to make a boring return selling covered calls against the TLT ETF for long periods of time. And then when we do get rare volatility spikes, that's when we'll jump into this premier group of companies and start selling in the money covered calls for huge premiums while volatility is high. The second the volatility drops back down, guess what? We're back out and into the safe trade. Okay, so now that you know the secrets of the strategy, obviously this is something you could do without me. Let me show you what I do 18 hours a day to provide extra value to our members. So it's important that you download a phone app called Telegram, and after you've installed it on your computer, on your phone, also install it on your computer. Every time we send out a trade alert, there's a link to join our Telegram group. This is where I'm posting important information that I'm collecting from Bloomberg, Seeking Alpha, Zero Hedge, CNBC, Fox News, everywhere important. We're following it 18 hours a day. We're looking at the futures market. We're tracking what's happening in the Chinese market, posting the speeches from President Xi of China. Anything that's critical or a large risk to the stock market, you're going to know about it first from this Telegram chat. The next day, I do take all these pictures and put it into a video. So if you don't want to have this live feed, then you can obviously not subscribe to it and just get the content from the video. But if you want it intraday, we have one chat set up for each of our programs. This is the Whale Club. This is the Diamond Club. So everything important is posted real time here first. Here's just a sample of some of the content I've posted recently. So we're looking at the reaction to the escalation against Huawei from Trump overnight. Caused a lot of pain in emerging markets, which are the primary trading partners of China. We're looking at breakdowns in data from America to signal potential risks ahead. Looking at overvalued IPOs and tech companies that are failing, like Uber, Lyft, and Pinterest. And most of all, right now, we're looking for political risks between China and the US, which could slow down trade globally and eventually cause a panic in the stock market. We're also tracking the dollar index. We're looking at leading indicators like the South Korea Kospi. We're paying close attention to the federal funds rate. Is Ray Dalio right? And Jeffrey Gundlach, are we entering a period of essentially backtracking towards the high rates of the 1970s and 80s? Because if so, we might be entering a period that's a lot like the last Cold War between Russia, and where America created lots of entitlement programs that created hyperinflation. And if you invested during the raging stock market from 1962 to 1965 and bought and held, you ended up losing money and getting back to even 30 years later. Let me ask you this. Can you afford to watch your portfolio slowly lose half its value over the next 15 to 20 years? Probably not. This program will not let this happen to you. You'll find that your editor is one paranoid, Debbie Downer, negative Nancy. We're always going to play it safe. Here's another data point. We're constantly watching the Treasury rates. Right now, the U.S. Treasury rates have inverted. That's a big no-no. We're constantly tracking inflation, which is the number one reason the Fed would raise rates. And guess what? It has been upticking all year. So there you have it. That's our strategy guide video. The basic program retails at $997 a year. The diamond program retails at $499.7 a year. And the whale program retails at $997 a year. But if you do call in, and at the top of each email there's a phone number, we can provide additional savings over the phone. So if you don't want to pay $1,000 a year, $5,000 a year, or $10,000 a year, just call us. We do have some discounts available over the phone. Now in the next video, we're going to go over the technical guide on how to find your spreadsheet, use the spreadsheet, and actually execute these trades. So if you need to, rewatch this video, and if not, go to the next video to learn how to use the mechanics of our software and how to punch in these trade alerts.